During January, there have been many reports of businesses struggling to deliver goods to customers in Northern Ireland. Amazon have halted deliveries of alcohol to Northern Ireland and have announced that they will further restrict the range of goods available to customers in Northern Ireland. Likewise, John Lewis have temporarily suspended deliveries of goods to Northern Ireland. But Northern Ireland remains part of the UK following Brexit and left the EU with the rest of the UK. So why is Northern Ireland now in such a difficult position? Following the Leave result in the Brexit referendum, the wheels were set in motion for the departure of the UK from the EU and the EU Customs Union. This necessitated the introduction of a customs border between the UK and the EU. The lack of a border would have meant that goods could flow into the EU, having only been subject to UK tariffs on imports from third countries, which might be lower than the EU tariff. To understand the current difficulties, we need to look back to the Good Friday Agreement, which was reached in 1998 and ended decades of conflict in Northern Ireland. Although the Good Friday Agreement doesn't contain any specific undertaking never to harden the border, the text only refers to the removal of security installations, it has been interpreted politically as doing so. During the Brexit negotiations, politicians from both sides stated that the introduction of a hard customs border would be contrary to the spirit of the agreement. With no hard border politically possible between Northern Ireland and Ireland, and the need for a border somewhere, the UK government reluctantly agreed in the October 2019 withdrawal agreement to the introduction of what is, in effect, a customs and regulatory border in the Irish Sea. Originally characterised as a backstop in earlier negotiations, the Northern Ireland Protocol is a key part of the withdrawal agreement and applies even though a trade deal was later negotiated between the EU and UK. There are two key tax aspects to the Northern Ireland Protocol. Firstly, the protocol provides for the imposition of EU tariffs on goods entering Northern Ireland from other parts of the UK, unless those goods are not at risk of being subsequently moved to the EU. Secondly, the protocol requires alignment with EU VAT rules on goods for goods entering, leaving, or moving within Northern Ireland. This means that import VAT is payable on some movements of goods to Northern Ireland. The VAT position is comparatively straightforward. Import VAT at the standard rate of 20% is chargeable on the movement of goods from Great Britain to Northern Ireland. There doesn't need to be a taxable supply to a customer. There could just be a physical movement of goods by the business. Where the movement is due to a taxable supply to the customer, that supply is zero rated for VAT purposes, so that there aren't two slices of VAT as a result of the transaction. Changes were made in 2020 which allow businesses to account for import VAT in their VAT return. This is known as postponed VAT accounting and means that there shouldn't be a cash flow hit as a result of the import VAT charge. Where the business uses the goods to make an onward taxable supply, it will be able to recover the import VAT as input tax. However, if the business is exempt or partially exempt, the business would have incurred irrecoverable VAT on the movement of goods to Northern Ireland. To mitigate the effect of this, businesses will be able to reattribute the previously unrecovered input VAT on the original purchase in Great Britain, as if the goods had been used for a taxable purpose, so that there is only one instance of irrecoverable input VAT. This is achieved by deeming the movement of the goods to Northern Ireland to be a zero-rated supply. The movement of goods to Northern Ireland must be within 12 months of the original supply to the business in order for this rule to apply. So, although there will be additional paperwork and VAT accounting procedures for businesses to go through, businesses should not economically bear the cost of import VAT charges on movements of goods to Northern Ireland. Let's look now at customs duties, which are rather more problematic. Customs duty is chargeable on movements of goods from Great Britain to Northern Ireland where the goods are at risk of being subsequently moved to the EU. There are two scenarios where goods are not at risk and where consequently no customs duties will be chargeable. Firstly, goods are not at risk where the applicable EU tariff on the goods is zero. This will be the case if, under customs rules of origin, the goods have a UK or EU origin. This is because goods which originate in the UK or the EU are subject to zero tariffs under the Brexit deal. No trader authorisation is needed. The business moving the goods can just make a customs declaration that the applicable EU tariff is zero, although the business needs to have proof of the origin of the goods in order to make this declaration. Secondly, goods that are for sale to or used by end consumers in Northern Ireland are not at risk. However, businesses must be authorised under the UK Trader Scheme in order to make this declaration, and must have evidence to demonstrate that the goods will be sold to or used by Northern Ireland consumers. Supporting evidence includes consignment notes, delivery receipts, and VAT invoices, and must be retained by the business for 5 years. Goods that will be subject to further processing in Northern Ireland must also satisfy additional criteria in order for a not at-risk declaration to be made. Isn't there a grace period though? Yes. On the 31st of December 2020, HMRC announced a temporary approach for parcels sent to Northern Ireland customers by businesses in Great Britain. During this 3-month grace period, customs declarations will only be required for Northern Ireland businesses receiving goods worth £135 or more. No customs declarations are required for goods below the £135 threshold, or for individuals receiving items valued above £135. But no details have been published as to what will happen from 1st of April onwards. There is also a 3-month grace period relating to customs declarations for certain types of food. This is only available to supermarkets and their trusted suppliers. In early February, Michael Gove wrote to the European Commission requesting an extension to the Northern Ireland grace period arrangement until at least 1st of January 2023. So why are businesses now restricting deliveries to Northern Ireland? I think the reason for this is that although it may well be possible to get to a zero customs duty position, either because the goods are intended for Northern Ireland consumers or because the goods have a UK or EU origin, businesses are not currently set up to make not-at-risk declarations. They may not have the information about the origin of their products, or they may not be capturing the supporting evidence needed to demonstrate that the goods are for sale to Northern Ireland end consumers. It is also not clear how long it takes to become authorised under the UK Trader Scheme, or how many businesses have successfully sought authorisation. These are very new rules, the finer details of which were not published until December 2020, so it's hardly surprising that many businesses have not yet got to grips with them. It remains to be seen what will happen at the end of the current grace period. This may just be teething problems which will ease as businesses get used to the new customs and VAT procedures. Or perhaps some businesses will decide that the cost of the extra administration required to make customs declarations means that it is no longer economically viable to continue to deliver to Northern Irish consumers. Perhaps the UK and EU will be able to agree to more relaxed arrangements in relation to Northern Ireland. Watch this space.